Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And today, Michael Becker could not join us. He was on assignment. We have in the podcast today kind of a legend, and I use that in the true sense of a legend in the multifamily business, a gentleman named Skip Bird. And Skip is with a group called S2 Capital and Real Estate Investment, and they're based in Dallas. And they're one of the most active owner/buyers in the Dallas-Fort Worth area. They own probably 11 assets for over 4,000 units. And so today, what we want to kind of figure out from Skip is, how he got interested in apartments, and then kind of help us create a roadmap on how you could also kind of mimic or kind of shadow how he did it, so you can get some insights from a true legend in the Dallas-Fort Worth multifamily apartment scene. So today, I want you to meet Skip Bird.
How are you, Paul?
I'm doing well. So Skip, again, is with S2 Capital, and that's kind of an interesting play on words because Skip has a partner, and the partner's name is Scott. Scott Everett is also with Skip. And Scott couldn't make it today, but I think Skip would tell you that it's always good to have good partners, and I think Scott's a good partner. How long have you guys been partners?
Scott and I got together in early 2012, so coming right up on 4 years.
Wow. And tell me a little bit about within the S2 Capital Group. You guys are buyers, owners, rehabbers, or multifamily properties. What do you do, and what does Scott do? Well,
I've been in the real estate business since 1984, and suffice it to say, Scott is a lot younger than I am. So I initially hired Scott as an analyst underwriter in 2012, and it quickly became apparent that his talent far exceeded that of an underwriter and analyst. So over the course of the first 18 months of our relationship, we went from employer-employee to partners.
Okay. And so you got started in 1984. Tell us a little bit about your history. I mean, did you immediately go into multifamily? Who did you work for coming out of school? And by the way, Skip is an attorney too. So he has a little bit of a professional background.
So I graduated law school in 1981, and I practiced law for 4 years. 3.5 years. I was a litigator and didn't like it. It was, particularly as a young associate, you read most of the day, and as I advanced, I became more and more convinced that I was more suited to being a businessman. The way I got in the real estate business was I was handling a $100,000 commission dispute between two real estate firms, and I happened to win the case, and an agent got a check for half of the commission, $50,000, which was a lot more money than I was making at the time, and he didn't seem all that super to me, and I thought, I can do that.
Yeah, I'm probably the smartest person in the room here, but he's the guy who has the $50,000 paycheck.
Yeah, so I approached the CEO of the brokerage firm. It was the largest brokerage firm in Kansas City, which is where I'm from, and I said, "Would you consider hiring me?" He said, "I'd love to hire you, but your boss is one of my best friends." And he said, "You need to talk to your boss first." So I went to the managing partner of our firm and told him that I was wanting to leave and go into the real estate business. He didn't really think that was a very smart decision, but I was pretty committed to it, and that's how I got in the real estate business.
So you got into brokerage business, and then tell us a little bit about, since that's 83, 84, 85, tell me, how did you come down to Dallas?
When I went into the investment side of the business, the first deal I did was I sold a duplex. So I really started kind of the ABCs of real estate. I started buying C- or D quality shopping centers in Kansas City in 1986. I had moved from the pure real estate brokerage side to real estate mortgage banking, and had a couple of big clients and did a bunch of structured capital where preferred equity and debt structures. And then 1987, 1988 hit. I had a really good year in 1987 and a pretty good year in 1988, and then everything kind of fell off the mountain as the real estate market crashed in 1988, the first big savings and loan failures. So I was struggling between 88 and 92, and I got a call from a friend of mine to go to California and go to work for this new company that was a joint venture between GE Capital and Robert Bass Interests called Colony Capital that was buying portfolios, really one of the very first groups, buying portfolios of failed real estate and loans from the FDIC. So not knowing anything more than that, I got on a plane and flew to LA, hoping that there was really someone on the other end. And Colony Capital was there, and they had a group of probably 10 guys like me that had 4, 5, 6 years of experience, but were kind of busted and needed to restart. And there wasn't any technology, but really about the only bad decision you could make in 1992, 93 was saying no to anything that crossed your desk, because that's how low values were. So I started working after a couple of months with Colony. One of the principals at Colony had branched off and was working on a multi-billion-dollar deal to buy from the FDIC that Robert Bass was the sponsoring partner. And we started working on the transaction, and the counterparty was the federal government. And there was a team of about 7 or 8 of us that, again, were experienced, and we were responsible for valuing, this $3.5–4 billion portfolio. Obviously, 80–90% of the value is in 10 or 20% of the assets, so that's where we focused. And we flew all over the country and met with real estate brokers and got broker opinions of value and figured out what stuff was worth. And then we'd have these negotiating sessions with the government's third-party vendors, valuation firms, and argue back and forth about what the value was. And the deal was, if the deal got made, we all had jobs in Dallas. And if the deal didn't get done, it was on to the next thing. And the deal was on and off 5 or 6 times. And on June 30th, 1993, the deal closed, and we had 120 of us in an office made for 50 people at the Centrum in Dallas starting July 1st, 1983. So that's how I got to Dallas.
Wow. What an adventure, especially with negotiating with the government. I mean, that tells you a little bit about Skip's background, able to negotiate. If you can win through the government, you can pretty much win at anything. So let's move up the dates a little bit and kind of figure out, how did you get into apartments? I mean, you did commercial, and then all of a sudden you got into apartments. How did you do that?
Well, if you're in the business long enough, when I was talking about how I got to Dallas, I talked about the first crash that I went through. Mm-hmm. If you're in the business long enough, you're going to see the cycles, and I've seen 2 or 3 of them. Sure. So I was doing retail development up until 2008, and really the music stopped very abruptly in August of 2008. And I still had assets, and I have, over time, fortunately gotten out of almost all of the shopping center retail assets I had. So I was faced with, okay, what are you going to do now? And I felt equally equipped to either go into the office building business or the multifamily business. It was about a 5-second debate in my head before I decided to go into the apartment business. So starting literally in August, September of 2008, started looking at deals, calling multifamily brokers in the market that I knew, and really trying to introduce myself into the local Dallas-Fort Worth market. Over the course of August or September of 2008 until all the way through 2009, well, actually for a year, probably looked at 30 or 35 deals. Wasn't sure how I would capitalize them, wasn't sure how I would borrow the money, but over the course of looking at all those deals, you learn submarkets, you learn who the really good brokers are and all that kind of stuff. And my first partner in the business, R.E. Nestle Development, I got introduced to him by a broker in August of 2009. And it so happened that this broker had 2 deals in the Lake Highlands area of Dallas that were in pretty deep trouble. They were about 40% leased. They were built in approximately 1983. And the bones of the projects were very nice, but occupancy in both projects had dipped into 40% range. And they had bond financing on them, and the bonds were in default. And Ari had a lot of experience. He'd probably already done 4 or 5 deals. He is a very creative and outstanding renovator. And I'd never renovated anything. Everything I had done, I'd built from the ground up. But Ari had always used family and friend type capital, and these 2 transactions were requiring substantially more equity than he had put in any one or two deals. And I had a lot of experience with the capital markets world, so it was a shotgun marriage that ended up working out quite well. And for the one and only time in my career, we literally bought these two properties on April 6, 2010 on the Dallas County Courthouse steps. I probably solicited 25 equity investors, and these were rough properties, very poorly occupied. And I finally hit on a group, a more or less startup real estate hedge fund called Pennybacker Capital, that was willing to say yes and take the risk and invest in the deal with us.
So again, how many frogs did you have to kiss before you found somebody that said, I believe in you guys, I understand the story?
Probably 20 or 25.
Okay, and so this group that you're talking about here is kind of a family office, would you say? Is it a small institutional office?
It was then. It isn't now. Their first real estate fund was about $30 million, and it was friends and it was small, wealthy family offices. Their current fund is approximately $330 million, and I believe they're out raising their next fund, which will be over $500 million.
Wow. So they were good equity partners. They're still good equity partners with you. But tell me a little bit about structure. I mean, they put money into the deal, you guys put money into the deal, and then you got debt on the transaction?
Yes, they were two separate deals, and we ended up borrowing money from two separate banks. Mm-hmm. Back in 2010, values were substantially different than they are in 2016. We bought these properties for under $10,000 a unit, which even then was an incredibly good price, but there were a lot of problems. So,
were they in foreclosure?
Well, the bonds were in default, and so in a very complicated way, they went through foreclosure, and that's why we bought them on the courthouse steps in a foreclosure sale.
Okay, and so you guys buy these properties, averaged about $10,000 a door, and then how many units was that?
It was 688 units, so it was just under $6.8 million in acquisition, and then we budgeted to invest roughly $10,000 a unit. I think we ended up putting roughly $9 million. So the total capitalization for both deals was roughly $13.5 million.
Imagine trying to buy something of 600 plus doors for $13 million these days.
Right, exactly.
Those were the oldie but goodie days. So where did the money go to? I mean, $9,000 a door, $10,000 on the acquisition. Where did you guys stick the money into the property?
So our leverage was probably 60 or 65% of the total capitalization, and the balance was equity, both from Pennybacker and we as the general partner. Not surprisingly, with the condition of the property, the occupancy, et cetera, there was a lot of deferred maintenance. So we did, on the exterior, we did a lot of wood replacement. We did a lot of landscaping. The parking lot needed a lot of work. Things like the security gates didn't work. We completely redid the clubhouse, completely after replacing wood, painted a new bright paint scheme at both properties. And it varies from project to project, but typically you spend roughly 60% of your renovation dollars on the inside of the unit and about 40% on the exterior. On those two deals, because of the condition of the property, it was much closer to 50-50. And on the interior, all new hard surface flooring. Early on, with Ari, we did stained concrete. We don't do that any longer. We use vinyl planking, which is a great product that's been developed in the last 4 or 5 years. We put in all new brushed nickel or stainless appliances or fixtures, pendant lights, track lighting, two-tone paint scheme, new mirrors, tile backsplash, resurfaced countertops, and over time, between the first deals we bought, which I was just talking about in 2010, and now, we more or less have a standardized interior finish package that if you walk in any unit in any of our deals, they should look virtually identical. So
from the period of time that you guys bought the property to the period of time that you sold the property, what was the time on that?
We bought the properties April 6th of 2010, and we sold one of them in August of 2012, so a little over 2 years, and the other one in November of 2012.
So we did, I think Old Capital did one of the transactions with a buyer out of California that liked the submarket, liked the scheme of the painting and the tenant base, and they just did a wonderful job putting Humpty Dumpty back together again. And the day that it closed, it looked great. Your occupancy was high. It was a nice project that you guys finished up. and I think it did pretty well in that transaction.
Yeah, that was one of the all-timers. It was a great deal.
So you had a good rate of return on that one for your investors. And then at what period of time did you kind of went off by yourself, and was that the next transaction that you decided to try to do the next one by yourself?
Yes, it was a great partnership. I learned a lot from Ari. Hopefully he felt the same way. He was focused in a different part of Dallas than I was. He was in a very concentrated area, and I wanted to look elsewhere. And I kind of earned a couple of stripes in the game and felt like I could do it on my own. So the first deal I did on my own, I put under contract in the summer of 2012, and it was a 184-unit deal in Denton, Texas, which is about 35 miles north of Dallas and is home to the University of North Texas, and is not necessarily considered a suburb, but it's in close proximity.
But just a great submarket. They took a 1970s product and updated the property with just absolutely brand new interiors to the property, redid the pool. Did you guys do the roofs too on that property?
Yes.
And stabilized the asset after they fixed it up, and they sold it to an operator up in the Denton area and did real well. And then I think after that you were off to the races. So you guys have done a number of transactions. You've bought, rehabbed, sold, and now you guys are just doing real well. Now, do you guys manage your own properties, or do you have third-party management companies?
Well, I vowed never to get into the management business because the management business is a people business, and depending on the size of the apartment community, you're going to have anywhere from probably as few as 5 or 6 to as many as 12 to 14 employees. And if you have ambition to grow, it doesn't take too long. We currently have 100 employees. So we started off using third-party management, and about the time that we grew and probably acquired our 6th or 7th deal, and we're upwards of 1,700 to 2,000 units, we were never happy. We were fortunate enough that we had really good on-site staffs at almost all of our properties, but we found ourselves taking the role of a regional or upper management of a management company and dealing directly with the on-site property managers because we just weren't satisfied with the attention we got, and it's not, nobody cares about your stuff like you do. So over the course of about a 4, 5, 6 month period, we started laying the groundwork in probably June of 2014, and we actually took over all of our properties on November 1st of 2014. We formed a company called S2 Residential, and the most important thing we had to do, because neither Scott nor I had multifamily management experience, nor did either of us want to actually be in the operational management side of the business, and we needed to find someone to run the company. And so that was the first step. We started off with a couple of employees corporately, and now we're up to 9, and our S2 Residential employs roughly 100 people.
Wow. And now also, too, is that we talked about the property management. You are the asset manager and then also have a property management piece to the deal. Do you also do your own rehabs of properties? Because you are a value added. Would you call yourself a value added
Yes.
buyer?
Our basic proposition when we buy a deal is there are certain characteristics we look for, and when we find them, our modus operandi is whatever it is we're paying for the property, we're going to plan to spend anywhere from a low of $8,000 to $9,000 a unit and a high of $15 or $16 per unit, which renovates the entire property. Common areas, we build outdoor living areas, dog parks, all those kinds of amenities that people want today. And then that also includes the interior unit renovations. So our basic model is you're spending on average probably $10,000 or $11,000 a unit, and we raise rents over time from $125 per unit per month to as much as $250 per unit per month, depending on the characteristics, the economic characteristics of the area and the asset, the property, when we find it.
So this is a highly competitive market in the Dallas-Fort Worth area to find something to buy, but you guys have been consistently buying properties. How do you guys, first of all, find the properties to buy, and how do you win the deal? What's your secret a little bit?
Well, you can't tell all your secrets, Paul.
I'm not asking all of them. Oh.
So the primary way that multifamily investment properties are acted in Dallas, there's a multitude of multifamily investment brokers that focus on all different property classes across the spectrum, but there are probably less than 10 that are considered the really, really blue chip firms that get the lion's share of the 200 plus unit listings. And for the last 3, 4, 5 years, they do what they call an indicative bid and then a best and final. So they will widely market the asset, and they will end up with somewhere between probably 20 and 40 offers in the form of a letter of intent, and they take the best 4 to 10 of those offers, and they invite those groups into a best and final competition. We've probably entered, over the course of the last 4 years, 10 of those, and we've gotten second. We've gotten a red ribbon for second probably 3 or 4 times, and then we've gotten a white ribbon for third probably 3 or 4 times. Unfortunately, we've never gotten the blue ribbon for winning one of those. So it didn't take us very long to figure out if we really want to grow and buy property, it's going to be a long haul, and we're not going to be very successful being the top bidder in that format. So we started spending a lot of time driving and a lot of time writing unsolicited letters of intent to owners. And I would say that I wish our hit ratio was 1 in 10, but it's probably even lower than that. We own across the Metroplex, so you know who your competition is. It's pretty amazing. We have a very sophisticated brokerage market, both the people that are specialized in financing as well as the guys that are actually on the investment sales side. And the top probably 50 people that transact, they know virtually every owner of every multifamily asset in the entire Dallas-Fort Worth Metroplex. So we would identify properties that looked appealing to us, and we've got a couple of brokers that we do business with all of them, but we've got some of the brokers are only interested in working on their listings. We found a couple of top brokers that were willing to kind of be buyers, representatives, if you will, and help us. And so what we found was early on, we would submit letters of intent directly to sellers without an intermediary, not really trying to avoid a fee, but just because we'd done the work, we figured that we'd just approach them directly. And what we found was we got very little response from that. But when we started sending them through a broker, our response rate, even though it's still low, was increased dramatically. The other thing that we've bought 16 deals. We have a 17th deal currently under contract. We've sold a few assets, which is why we only have 11 now. But of the 16 that we've bought, I would guess that at least 5 or 6 of them, from the time we identified the property and knew we would like to try and buy it to the time we bought it, could be 9 to 12 months, because frequently you either get no response or nice try, but I'm not interested at your offer price response from the seller. And, we would wait a month or two and resubmit at a higher number. Then a subset of the assets we've bought had in-place financing that we had to assume. So you've got to go, and that's typically either through Fannie Mae or Freddie Mac, and that takes a minimum of a 90-day period of time to get all the paperwork done to assume. So, every once in a while we've done a deal reasonably quickly, but, we get told no 3 times, and on the 4th time, they say yes, sometimes. And that's how we've built our portfolio.
So you and I just came back from the National Multi-Housing Council meeting down in Orlando, and you talked to a lot of people that possibly would want to sell their buildings in the Dallas-Fort Worth area. Tell me, what's your gut check right now? How is the apartment business in Dallas? Competitive? Has more legs to run? What's your take?
Well, it's been such a good market for such a long time that I think everybody is worried that we're at the 11 o'clock hour at night. And there is no indication of that at all. There's no indication of it from the standpoint of tenant demand. There's no indication of it from the standpoint of rents. Now, mind you, we're in the middle of the market. And what I mean by that is our properties are workforce housing. We don't have the brand new resort pools, sand beach volleyball kinds of properties, so that are commanding $1,500 to $1,400 to $1,800 a month rents. Our average rental rate is probably in the $800 range. So we're dealing with working class people as our tenants. Having said that, the rents have still grown probably a minimum of 4 to 5% a year over the last 4 or 5 years, and that continues. Dallas is a real anomaly, I think. I really believe that the Dallas-Fort Worth area is the very best apartment market if you're eliminating urban markets like New York or Chicago. But for a normal suburban market city, I think Dallas has got the best probably economy in the country and certainly the best apartment market. And we've had incredible job growth here, and it continues. So I really, I'm not smart enough to predict how long it's going to last. And we are a little more cautious today than we would have been in, say, 2014.
Yeah, but you take a property that's an older property, let's say it was built in the 1970s, 1980s or so, and you kind of convert it up and bring it up to date. You do some of those. I don't think you do the sand beach pools, but you do the dog parks and the places to hang out next to the pool, whether it's a outdoor oven. You guys just do a great job on updating these properties, and you can demand increased rents. And just like you said, you are not an A-class builder, a developer. I mean, you take these properties are kind of like Humpty Dumpty, and you kind of breathe brand new life into these properties. No, so for the last 5 or 6 years, you guys have used family office, small institutional money, and you've made those people a lot of money. Again, describe what a family office is and what little institutional groups are.
Well, a family office is typically a family, and depending on how wealthy they are and how broad their reach, they can be pretty big organizations, but typically they're 3 to 10 people, and some include family members and third parties that they've hired to manage their family's wealth. And typically, depending on their appetite, they have some allocation into real estate investing. So a family office is a kind of fancier or industry term for very wealthy people that are interested in investing in real estate. Institutional, you have everything from the big life insurance companies that invest with what they call core and A-class new built properties down to real estate hedge funds and other syndicators that invest in B and C class real estate like what we do.
Now, you guys put a lot of money of your own into these transactions. Would you also consider, if you had high net worth individuals, to invest in these transactions with you?
In fact, it has been a goal of ours for some time to buy a deal so in a typical deal in our portfolio, our deals require typically a minimum of $5 and as much as $12 to $14 million in equity. And those are on deals that are typically 250 to 500 or 600 units. It has been a goal of ours, and we've been looking for the last 6 or 8 months to find a deal that required $2 to $3 million in equity so that we could do exactly what you just described, raise the money ourselves with high net worth individuals and people that, have $50,000 or $100,000 and they want that really don't have access to investing in larger multifamily projects. And just yesterday we put a 167 unit deal under contract, and I started this morning working on trying to raise $1.9 million in individual investor kind of equity.
Yeah, Skip and I have no relationship, so this is not a solicitation. This is just an idea that if you do want to talk with Skip at some period of time and develop a relationship with him, and he's an SEC compliant person, so he'd have to get to know you, and you'd have to get to know him, and kind of figure out what he does and what those properties look like, because you would be a direct investor into these transactions. So tell us a little bit. So you have one property that's on the radar right now. It's 167 doors.
Yes.
Yeah, we did the financing on that property back 3 years ago for the gentleman who owned it. Unfortunately, he passed away, and so it gave Skip an opportunity to buy the property. So this is a story of people. This is a story of building a business. Any funny stories that you have out there, Skip, of people in the business? Anything you can think of that's rated G for everybody?
Yeah, I was going to say most of them I probably can't tell. But one story actually does come to mind. We started off talking about the first 2 deals in Lake Highlands that I bought in partnership with Ari Nessel. And the city of Dallas has, water conservation in 2016 and even back then is a very important social issue and environmental issue. So municipalities sometimes have incentives or programs where you're incented to save water. So the city of Dallas has what they call a toilet voucher program. And just a detail, old antiquated toilets use 3.5 gallons on average per flush. In new technology kind of toilets can be below 1 gallon, but high efficiency, I think, is considered under 1.6 gallons. So the city of Dallas had a program where you had to use their specified toilet, but they would basically give you new toilets for your program. Well, it's a governmental entity, so there's a process. And we got a little bit ahead of ourselves, and I got a call one day at my office from our manager. And we had been installing the new toilets probably for 3 or 4 weeks. And she said, "What is going on? The maintenance guys, are removing the new toilets and putting the old toilets back." Well, we figured out after we'd been doing it for a couple of weeks that someone from the building codes office had to come out and inspect your old toilets, to make sure that they were inefficient. They were 3.5 gallons, or there was a standard that they had to be above in order for you to qualify for the voucher program. So my manager called me. She didn't know what to do because we just installed all these new toilets. And so what I found out was the city inspector was coming out, and we figured out that we had to have the old toilets in and not the new toilets. So we had to rush out there and take the new toilets out and put the old toilets back in. And that was probably the weirdest thing we've ever done.
And how many toilets were?
It was probably 40 or 50.
Oh, my God. So any insights, a lot of people that listen to this podcast want to become like you. So looking back on your successful last number of years, any inside stories, anything that you think would help somebody that was, say, in your shoes 4, 5, 6 years ago to get them to where you're at right now?
The good thing about the real estate business is that you don't need to be a nuclear physicist to be successful in the real estate business. It takes a willingness to roll up your sleeves. You have to have, I think, a fair amount of common sense. You probably helps a lot if you have decent people skills, and you do a lot of driving and you look at properties, and then you find out who the people are that are experts at what you're trying to learn. And you find somebody that's willing to spend 10 minutes or a half an hour talking to you, and you kind of snowball from that and over a period of time. And it doesn't have to be a long time. If you're doing it as a hobby, probably take you a lot longer than if you decide either because you're financially able or you go to work for somebody that you're going to make it a full-time avocation, which, of course, Scott and I both do. So we're still learning. We still make mistakes. But it's really talking to people that are experts. It's learning a market. It's understanding where rents are. The great thing about multifamily, you can go in to a project and shop it. You can, if we own a property in a market, all the managers of properties within blocks all call each other. What's your occupancy? What are your rents? What are your concessions? And, 100% of the people aren't cooperative, but probably 90 or 95 are, because they know they're going to need that information. And, you're not out in the parking lot trying to steal prospects as they're walking in the door to inquire. But so there are, or you can walk in and you can pretend that you're interested in leasing an apartment, and you will get most all of the information you need to start understanding the economics of an apartment deal. I think a lot of people start, if they're interested in housing, they start buying and either rental houses and fixing them up, or in a market like Dallas, they buy houses, they fix them up, and they flip them. And I think a lot of those people kind of segue into, buying a 12-plex or a 24-unit deal, because it's just as much work. One of the things we always say is just as hard to do a small deal as it is to do a bigger deal. You have all the same elements and components. So I think people frequently start small, and after they get their legs under them, they realize that kind of for the same effort, obviously the dollars are typically bigger, but for the same effort and as they gain confidence, they want to go to bigger things.
So for the last half hour, 45 minutes, we've been chatting with Skip Bird with S2 Capital. Skip Bird with S2 Capital, based out of Dallas, owns over 4,000 apartment units, 11 actually properties in the Dallas-Fort Worth area, almost going to be 12 coming up here in the next month or so. Skip, if somebody wanted to get a hold of you, what's the best way of trying to track you down?
My email address is sbird, my name is spelled B-I-R-D, at S as in Sam, 2, CP, charliepaul.com.
One more time on that email address?
sbird at s2cp.com.
All right, Skip, thanks for spending some time with us in the Old Capital Investing Podcast. We appreciate it, and thank you very much.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.